Hey there and welcome. Today we're going to pull back the curtain on something that can seem super complicated, technical analysis. In this quick crash course, we're going to give you the tools you need to finally understand what all those crazy lines and bars on stock charts are actually trying to tell you. All right, let's dive in.
Have you ever stared at a stock chart and just felt completely lost? You know, with all the lines and colors and weird acronyms, it can honestly feel like you're trying to read a whole different language. If that's you, trust me, you are not alone.
But here's the good news. It's not as hard as it looks, and I promise, in just the next few minutes, you're going to get the hang of the absolute basics. Our goal here is to give you that fundamental vocabulary so you can start to understand the story these charts are telling.
So, here's our game plan. First, we'll cover what technical analysis even is. Then, we'll get into how to actually read a chart. After that, I'll show you your first couple of tools, give you a 5-step plan to get going, and we'll wrap up with some really important things to keep in mind.
All right, first things first, what in the world is technical analysis? Well, when you boil it all down, it's really just a way of understanding market psychology. It's about seeing the collective emotions, the fear and the greed, of everyone trading all laid out on a chart.
The textbook definition says it's a method for trying to figure out where prices might go next by looking at where they've been. See, instead of digging through a company's financial reports, technical analysts believe that everything you need to know, all the news, all the earnings, all the hype, is already baked right into the price you see on the screen.
And this is a really, really important distinction to make. It's totally different from the other main approach, fundamental analysis. Think of it like this. Fundamental analysis helps you answer the question, what should I buy? You know, is this a good, solid company? Technical analysis helps you answer, when should I buy? Is now a good time, based on what the chart is telling us? And honestly, the best investors often use a little bit of both.
Okay, so we've got the what down. Now for the fun part, the how. Seriously, learning to read a basic chart boils down to just 3 core ideas: spotting the trend, and then finding what we'll call the floor and the ceiling. Job number 1, always, is to figure out which way the wind is blowing. What's the trend? Is the price generally making higher highs and higher lows? Boom, that's an uptrend. Is it making lower lows and lower highs? Well, that's a downtrend. Or is it just kind of bouncing around between 2 levels without going anywhere? We call that a sideways or ranging market.
You've probably heard this one before, but it's a classic for a reason. Let the trend be your friend. It's just so much easier to swim with the current than against it. So your first job as a chart reader is simply to identify that main direction.
All right, let's talk about that floor. In the trading world, we call this a support level. It's basically a price point where a stock has a history of stopping its fall and bouncing back up. Why does this happen? Well, think about it. At that price, a whole bunch of buyers suddenly think, hey, that's a good deal, and they jump in, creating a floor that holds the price up. And you guessed it, if you have a floor, you've got to have a ceiling. We call this resistance. It's the exact opposite of support. It's a price level that the stock struggles to break above. Here, sellers tend to take profits or short the stock, pushing the price back down. So these 2 levels, support and resistance, basically create the playground for the stock price. Awesome. So now you can spot the trend, the floor, and the ceiling just by looking at a chart. That's huge. Now let's give you a couple of simple tools, which we call indicators, that can help confirm what your eyes are seeing. We're going to look at 2 of the most common ones out there. You'll see them everywhere. First up is the Glidande Medelvade, or moving average. This thing is amazing. It just smooths out all the choppy, day-to-day price noise into one clean line so you can see the underlying trend more clearly. A super simple rule of thumb: when the price is trading above its moving average, the trend is generally considered up. Next is the RSI, or Relative Strength Index. If the moving average is the market's memory, think of the RSI as its mood ring. It tells you if a stock is overshot or overbought, which is kind of like a car engine running in the red. It got too hot too fast. Or it can show if it's oversold or oversold, meaning maybe the sell-off was a bit of an overreaction. It helps you gauge momentum. Okay, enough theory. How do you actually do this stuff? Don't worry, I've got you covered with a super simple 5-step checklist to help you do your very first analysis. Step 1, just get comfortable with these basic ideas we've talked about. Step 2, pick a charting platform. There are great free ones like TradingView. Step 3, just start drawing. Pull up a chart and try to draw lines for the trend, support, and resistance. Step 4, add those indicators we just talked about, the moving average and the RSI. And Step 5, and this is the most important one, just practice. Follow a few stocks, see how your analysis plays out. You don't even need to use real money. All right, before I let you go, we need to have a serious talk about a few really important things.
Think of this as the read the warning label section. Getting this right from the beginning will save you a lot of pain later.
Okay, number one, and please burn this into your brain, technical analysis is not a crystal ball. It does not predict the future with 100% certainty. It's all about playing the odds. It helps you find setups where you have a better chance of being right, but you can, and you absolutely will, be wrong sometimes.
And because you will be wrong sometimes, this next point isn't a suggestion. It's a rule. Always use a stop loss. A stop loss is just an order you set beforehand to automatically sell if the price drops to a certain level. It's your safety net. It's your eject button. It's what keeps a small mistake from turning into a disaster.
And finally, just a few quick tips to help you get started on the right foot. Stick with big, well-known companies at first. They're more predictable. Don't be afraid to mix in some fundamental analysis to get the bigger picture. And please, start small. There's no need to rush. Definitely avoid those tiny, obscure stocks in the beginning. They can be super volatile.
So, look, are those charts still a little intimidating? Maybe, but they're not a foreign language anymore, right? You now have the basic vocabulary. You know about trends, support, resistance. You've got the building blocks. So the real question is, are you ready to start putting the pieces together and see what the market is trying to tell you?